Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this episode, we are going to take a hard look at the RBI's latest bi-monthly monetary policy announcement that was made on Friday. Contrary to market expectations, the RBI chose to maintain status quo on repo rates. This came as quite a surprise to the markets, which had largely factored in at least a 25 basis points hike in the repo rate. One would have expected markets to be very happy when the RBI did not hike rates, but contrary to expectations, the markets reacted very adversely. What is the reason? Could it that you can never keep markets happy? Or is it that somewhere along the way, markets have lost confidence in the RBI's ability to be on top of the situation? Joining me in the discussion to discuss this and many things more, I have with me a panel of experts. Harun Rashid Khan, former Deputy Governor of Reserve Bank of India, Pradeep Kumar, former Managing Director, State Bank of India, and Abheek Barua, Chief Economist, HDFC Bank. So I have with me a central banker, a banker, and an economist to give you a 360-degree view of the RBI's latest policy. Welcome to the show, Khan, Pradeep, and Abheek. So let me start with taking very brief opening comments from all three of you. Mr. Khan, were you somewhat surprised, puzzled by RBI's failure to act on the rate front, or did you think that this was what was called for? Very briefly, and then we'll get into the details.
I would say market was expecting, almost everyone is expecting either 25 to 50 basis point hike, and given the current situation, most of the market participants are expecting the neutral stance to continue. The way the policy has come out in terms of taking a pause on the rate action, and in the stance action talking about calibrated tightening, I think that has surprised the market. But given the mandate which RBI takes rather too seriously about inflation targeting, it is not surprising to me, because they have already taken two preemptive rate hikes earlier, and they themselves have said we are taking an insurance policy. And now that the immediate short term inflation trajectory indicates a benign trajectory, they have gone for a pause.
But as we know, with insurance policies, they are only insurance. They never really guard you against, what can be complete virtual certainties. But let me now turn to you, Pradeep, and ask you, were you puzzled, surprised, or were you not at all surprised by the RBI's lack of action?
I think as Mr. Khan was saying, the street was expecting at least a 25 basis point increase in the repo rate. So I was also, my view was also along with the street, was expecting a 25 basis point increase in the rate. Quite surprised that RBI didn't increase, but I would have expected an increase with maybe a neutral stance given the lower expectations of inflation that they have projected. But it's rather surprising they didn't increase the rate. The inflation expectations have been slightly lower than what they have said in the last policy, but they have made it a calibrated tightening. So it looks quite contradictory, quite surprising. I think the currency market and the equity markets have reacted very adversely, and although the yields have improved, but this yo-yoing of rates, I think will make banks struggle with their M2M, especially banks which have large AFS exposures.
Obi, could you share the view of both Mr. Khan as well as Pradeep that the RBI's moves were slightly contradictory and completely out of kilter with market expectations? So are you also surprised, confused? What is your view, Obi?
No, surprised, confused, and indeed disappointed, because not just with the absence of a rate hike, but I think in the communication, particularly the press conference, the pressure on the rupee and the stress that we face on the external front, I thought was grossly understated. It often helps to call a spade, recognize that there is a crisis, and at least communicate to the markets that there is some concern within the central bank about what is going on the external front. This sudden and typically in the past, they have intervened strongly. They have tried to hold certain levels, and there was a feeling that the RBI would get fairly antsy about the kind of pressure that we faced in the market. There could have been innovations of the kind that we saw in Mr. Khan's time haven't come through. There's been no communication from the market, and suddenly we are told that the RBI believes in this look ma no hands kind of approach and lets the market decide where the rupee is going to go. I honestly don't think this is prudent in the middle of what I think is a fairly severe crisis, and the market's reaction in response to the RBI's action just I think bears me out.
Khan, the governor's defense when he was questioned about the action or the lack of action in the press conference was that the RBI's monetary policy must be exclusively focused on inflation targeting and reining in inflation. And his defense was that this is a legislated mandate. Now, does that ultimately result in the RBI and the MPC taking a very narrow view of monetary policy, because monetary policy, particularly in a country like India, must look beyond interest rates? So do you think that was somewhere missing, Khan, in the entire process?
Anyway, I will have a very biased view. I belong to that old school of multiple indicator approach. I, like many others, are not great fans of inflation targeting. But nevertheless, this model has been adopted, and we have to allow it to run its course and see how effective it is. But the point, even in the context of inflation targeting, one has to keep two aspects in view. One is internal value of rupee, other is external value of rupee. When you are talking about internal value of rupee, price stability is certainly something you have to focus, and price stability is one of the dharmas of central bank. But then the price stability has to be in a context, and as we have seen, price stability does not necessarily guarantee financial stability. And the other point which I mentioned, external stability or the external value of rupee, that is also very important for price stability. In a country like India, I think stable exchange rate, relatively stable exchange rate is a public good, and that is one of the essential ingredients of financial stability, and that has impact on inflation also. If you have a free fall rupee in terms of its spillover effect on the inflation trajectory also is there. So one has to take holistic view. I think RBI is conscious of that, but in terms of communication, probably they are trying to re-emphasize and reinforce their inflation targeting. But I think they are not oblivious of the fact that rupee is something which cannot be allowed to be go for a free fall. I think immediately after the press conference, I think some action has happened possibly. That is why you see there is some action, retreat in terms of rupee's valuation, where it has gone and where it is now closed at the end of the day. So my short point is that whether you admit or do not admit, for disorderly movement of rupees, you have to intervene. So if you are intervening, then you should give some communication to support that intervention, rather than fighting side of not telling that or giving a perception that we are not so much concerned about rupee. That is my only limited point.
Okay. Pradeep, would you share that view, which I frankly do, with Khan, that in a country like India, you need to have a much more holistic view of monetary policy? Pradeep?
Yeah, I agree with what Mr. Khan said. I think we must have a holistic view. And we also know that the exchange rate variations, the imported inflation also affects the inflation. So the managing of the exchange rate is also very important. Unfortunately, in the press conference, the body language and the words used by the Deputy Governor seem to indicate to the market that RBI are hands off the currency markets. That is the impression that has been given. And even his body language even said so, that unless there is a extreme volatility, we are not going to interfere. I think communication to the market is very important. You have to intervene when it's necessary, and also tell the world that you are intervening. I think both these were missing in the press conference as well as the body language. They seem to have blinkered view on inflation, but I believe when you are, even if you have a blinkered view on inflation, currency market is a factor which affects inflation, especially in a country like ours where we have a current account deficit, we import inflation through energy. I think it is very important. I think management of exchange rate is also equally important along with the management of inflation.
Oh, in fact, I couldn't agree with you more than that, Pradeep. But in fact, Abheek, the reason why an interest rate hike is used by most central banks, particularly if you have a current account deficit, is that it attacks both sides of the problem. On the one hand, by restraining demand, it helps you get the current account deficit under better control, and by encouraging debt flows, at least, it helps on the financing front also. So do you think the RBI's complete ignoring of the other aspects of monetary policy is perhaps going to cost us dear, and somewhere down the line RBI might have to act much more harshly, precisely because it missed the bus today, and at a time when markets had actually factored in a rate hike?
Oh, absolutely. I think they have missed a golden opportunity to actually play to the gallery when it was warranted. And exchange rate depreciation does lead to inflation pressures. Whether it gets reflected in the narrow calculations of short-term inflation because one other component, which is food, has shown extremely benign patterns of movement in the recent past, I think is too narrow and almost a clerical view of the inflation targeting. I think we'll have to look beyond that, and what it could end up doing is the increased uncertainty about depreciation would actually lead to greater outflows from foreign investors. So that's the capital account part of it. And I have a feeling that it could impede and impair domestic growth impulses, because, for instance, they talked about higher capacity utilization. Now, in one of the areas where capacity utilization was increasing was cars and trucks, and there, with the effective price of petrol going up so much, along with the possibility of larger funding costs because of the NBFC entanglement and so on, we could see both inflation risks as well as diminished growth. So a stagflationary kind of situation which could arise. I don't think it was sort of thought through terribly carefully.
Okay. Well, that's not very complimentary to the RBI, not thought through very carefully, clerical view, and both Khan and Pradeep also are not quite enthused by the RBI's approach to the monetary policy statement. But on that note, it's time for us to take a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three experts, one banker, one economist, and one central banker on the RBI's fourth bi-monthly monetary policy statement. Khan, if I can just stick to the same idea of inflation targeting, the inflation is supposed to be forward looking. Monetary policy is supposed to be always forward looking, whereas the RBI's latest policy statement seems to take comfort from past inflation. And even though it lists out a number of factors which are likely to increase inflation going forward, in fact, many of them are virtual certainties, given the way the dollar is strengthening, the rupee is weakening, oil prices are rising. So all these factors would expect inflation to go up in future. But monetary policy seems to have been framed looking at the rear view window. Is this at odds with RBI's past way, way of looking at things?
No, my understanding is they had already done 2 rate hikes, and the last 2 prints of inflation has come below what was expected, and next few, and their inflation projection for the second half of this year and first quarter of the next year is lower than what they had estimated earlier, and they want their past action to play through. But going forward, as number of risk factors starting from oil to rupee to fiscal to HRA, MSP, the whole host of things are lined up, which is likely to add to the inflationary pressure. That is why they have very clearly say calibrated tightening. Calibrated tightening means there is no question of any either it is a neutral or rate hike, there is no question of rate reduction. So rate hike is most likely will happen as the most of the risks will materialize in the near future. So I think they are very clear in terms of this. If not now, going forward they will raise the rate, but having regard to which they have not said so clearly, having regard to the conditions which may affect the other in the sentiments of the system, they have put that specific prefix of calibrated tightening. That means every time you have a 25 basis point increase, not 50 basis point. So that is what probably has given comfort to the bond market, and that is why the bond market has rallied. That's my sense.
I hope you're right on that, and the market is satisfied with that word calibrated tightening, though frankly it makes no sense to me what exactly the RBI means by that. Pradeep, if I can shift now to the banking sector, with which you're a master of. Ever since the RBI shifted to inflation targeting, there's relatively very little importance given to developments in the banking space. So we've seen Part B, which is about developmental and regulatory role of RBI, becoming smaller and smaller in terms of the number of pages, in terms of the kind of attention that it receives. And this time, in fact, despite all the problems that we saw in the NBFC space, there's virtually no mention of it, hardly anything at all. And we saw the Deputy Governor in charge of commercial banking. In fact, he did not speak at the press conference at all. So does it seem as the RBI no longer really takes its role as banking supervisor and regulator, and the interconnections between the banking sector and the monetary policy, all these somehow are given the go-by by the RBI under its new monetary policy legislation?
No, I don't think they have given a go-by, but I think the monetary policy event is strictly treated as a monetary policy event. All the regulatory issues come through separate directives and regulations from the RBI. Normally, if in the earlier days of the earlier governors, we used to see, along with the monetary policy, some other regulatory changes also being announced along the policy. Perhaps this governor treats this strictly as a monetary policy event, and the regulatory actions or any actions are done separately. Even today, of course, the NBFC crisis was mentioned in passing by the Deputy Governor, and only there was a mention of the crisis, what action they are taking. I mean, there was nothing in the policy statement, nor in the press conference, nothing was hinted. Sometimes I also get the feeling that you have that maybe the governor is more towards, importance to monetary policy, less to banking regulation. But maybe this is his style to separate these two. This is a monetary policy event. Regulations is a continuous process, and it happens continuously with the RBI.
True. But the fact is that what happens in the banking sector has very crucial implications for what happens with monetary policy, because remember, bank money is demand deposits, time deposits are part of your M3. Abheek, this brings me to my next question, that when you look at interest rates and you hike interest rates, it also has an impact, of course not completely, on household savings. And one of the things that we are seeing is that household savings in financial assets has been coming down. So has RBI completely ignored that aspect? The RBI keeps talking about liquidity and how it's going to inject durable liquidity through OMOs. But the fact is that the most durable kind of liquidity comes from deposit growth. So does the RBI is quite impervious to that kind of liquidity, and it seems to think that it can manage liquidity only through OMOs? Abheek?
No, I'm certainly not, and I think the RBI is cognizant of the situation, and the insistence on maintaining a 4% headline inflation target is part of this effort to keep real interest rates at fairly attractive levels, and coupled with appropriate changes in the nominal interest rates, feed the system with adequate household savings, and on a more short-term basis, infusions of durable liquidity through open market operations become necessary, because you have forex intervention which takes rupees out of the system. So I wouldn't necessarily say that the RBI has kind of jettisoned that objective. I think it's very much on its agenda, and the fact that it is seeking a steady state level of 4% inflation going forward is indication of the fact, partly that they want the financial system not to be starved of liquidity or funds. On the other thing also, I think if I could just slip in a quick comment, I don't really think, although there was nothing on the NBFCs in this particular policy, and it was devoid of too many regulatory announcements. But the fact is, you can't fault the RBI on its recent moves on vigilance and regulations. It has perhaps been criticized in some quarters for being hyper vigilant, but that said, I think it is now showing who's the boss and taking very decisive steps. So I don't really think I would want to fault or blame the RBI on that count, just because the structure of the monetary policy process makes it difficult to include too many regulatory announcements.
Okay, now let me just shift to something that has relation to the CAD financing. Khan, the RBI seems to talk about a voluntary retention route for foreign portfolio investors. How successful do you think this will be at a time when US interest rates are rising? And as we have seen, foreign portfolio investment in corporate bonds, I know you're a dada of corporate bonds, but the corporate bond market doesn't inspire much confidence in India. What would you say, Mr. Khan, to that?
No, I think it's on the face of it, it looks a good move, because the foreign investor under that voluntary retention route possibly will have lot of flexibility. They can play around short term, long term. I think that it's a instrument worth trying, and I think it can attract some long term money. Maybe they can put 3-year or 4-year lock-in within that period. But of course, profits is always repatriable. Whatever profit or interest you make out of your investment, that's all repatriable, because you are free on current account. But rest of it, it's the principal is locked in for 2 to 3 years or 4 years, and within that you have a lot of, you can have a trading desk, you can play in the short term paper. I think a lot of flexibility can be. I think it's a good move. Of course, the details are awaited, we have to see, but at the same time I think market was expecting some decision from RBI about the relaxation relating to the 20% and 50% in FPI regulations. I think that probably will come separately. But this in itself looks like a promising instrument.
Okay, I hope you're right in that, and there is some redeeming feature in the latest bi-monthly monetary policy. But on that note, I'm afraid we're completely out of time. Thank you so much, all three of you, for joining me. Clearly, the verdict is that the RBI has somehow fallen short, and we do hope that the RBI has called right. Otherwise, all of us will be in deep trouble. Thank you so much, Khan, Pradeep and Abheek, for joining me in this discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.